Hello, it's Friday, August 23rd, 2019. I'm Steve Houston with Compass Communications, and I'm here again with Joe Terril of Terril and Company, and we're going to talk a little bit about the markets and investing. And Joe, it's been a while, but I want to take you back to your July 3rd, 2019 blog, where you were explaining why you were reducing your portfolio's exposure to stocks and to long duration bonds. And you stated as the reasons, the market doesn't seem to care that the budget deficit is now running at more than $1 trillion per year, an all-time high. Pundits say deficits don't matter anymore. We disagree. Cover stories in mainstream business media proclaim the death of inflation. It is buried forever, the experts say. Again, we disagree. Investors seem to trust that no matter the real-world shocks dealt to the international economy and investment markets, central bankers will simply cut interest rates and save them from losses. We believe that could be a very costly assumption. In 25% of the industrialized world, interest rates on newly issued debt is negative. Yes, banks are paying the buyer to warehouse their money. This is not normal. Now we have, fast forward to today, there are concerns about the yield curve, and economists saying we're looking at a recession in 2 years, and the solution by the president and his allies seems to be cut interest rates. What are your thoughts?
Well, I'm going to apologize in advance here to you because I got a lot to say today.
I figured.
Because what's going on right now is being perceived by the public and being presented by the administration, investment markets, and etc. in the exact wrong way. And let me start with saying that the idea that somehow cutting interest rates is going to save the economy is completely wrong. And if anything, it actually tends to hurt the economy a little bit. But let's back up to what is the problem. The problem is the administration has started a trade war with China. Between the United States and China, we're 48% of the world economy. Other countries that sell to both of us, Australia, New Zealand, Indonesia, and such people, Vietnam, that sell to China are not selling. Some of the European countries that sell to us and China are not selling. So the problem, point blank, is the trade war that is going on. This morning, China announced we're going to initiate tariffs on an additional $80 billion in U.S. products, including automobiles.
They upped the ante.
It has nothing to do with interest rates. And the market's expectations that, well, if we cut interest rates from 2.25 down to 1.5, that's going to make the economy boom. It's absurd. It really is.
And the president also tweeted a couple of days ago that quantitative easing would be something that would be beneficial.
Here's how ridiculous this is. The president did say the Fed should lower interest rates by 1%, and they should do more quantitative easing, which simply means they should print money and go buy treasury bonds in the open market to lower the yield on bonds. A 10-year treasury bond right now only yields 1 5/8. The notion that if we could get that yield down from 1 5/8 to only 1% is somehow going to spur economic activity. Think of it this way. Is the consumer in the United States right now looking and saying, you know, I think I'd go buy a new car if these 3% interest rates had just come down to 2%, then I could afford to go buy a new car. Gosh, if mortgage rates had come down from 3.5% to 2.5%, I'd go buy a new house. I'd buy new furniture. the cost of money is not a problem. Corporations are not sitting in their boardrooms going, you know, I can borrow money right now at 3%, but I'm not going to. That's way too high of a cost of money. If fund and the rate on money would come down to 2.25%, I'll go borrow billions and build new plant and equipment and hire people. It's a ridiculous comment, and you're real proof that that's not the issue and not the problem. Look no further than Japan and Europe, two different cultures in two different parts of the world. Both have negative interest rates, and the economies are in the tank. So somehow, if lower interest rates are going to spur your economy and really make it pick up and go, how come it's not doing it there? Their rates are so low, they're negative. Their economy, Germany arguably, is just entering into a recession. The low interest rates is a problem. It hurts, it doesn't help, it destroys confidence, it destroys people's projections of I'd better save even more and not spend because the interest rates are so low. It's a hidden tax on the banking industry. So any thought by the administration and or the investment markets that, well, Jerome Powell and the Federal Reserve Bank will come to the rescue in the United States with lower interest rates, and that will help keep our economy from going into recession. It's absurd. It's a ridiculous thought.
So you made some significant adjustments to your portfolio back in July. Do you see any tweaks you're going to be making here in August and moving forward?
The real issue and the problem that you have right now as an investor is they could call off this trade war tomorrow morning. If they did, you want to own these assets. If they don't, and this is an ego issue more than anything, and it's going to continue to get worse, then you don't want to own this, you want to own over here. Very difficult to know what's going to happen here. There are people that think the Trump administration is going to call it off, declare victory, which there isn't, and try and get reelected. There are, and we tend to lean this way, there are people that believe, he's insulted Chinese leaders so much that they absolutely aren't going to settle a darn thing until after the election next year. And I tend to think maybe that's the case, that China has no interest in settling this issue. So I believe investment-wise, you have to consider, proceed with caution. You have to look at the things that are providing good income. We really are watching more and more. You can't make any income off bonds. Like I said, a 10-year Treasury bond at 1 5/8, and corporates aren't much more. You might be better off buying some of the good value stocks that are paying 4 and 5% dividend yields.
Okay. Well, thank you, Joe. As always, it's interesting. That's Joe Terril, founder of Terril & Company, independent wealth management with $700 million in discretionary assets under management. Joe, let's visit again in a month and see where we are at that point.
We'll do it. It's going to be fascinating to see how this plays out.
Thank you. And thank you for joining us.